Welcome to this Killick Explains video, and this week, I suppose not surprisingly, I want to look back and consider 5 investing lessons from 2023. I tend to do this each year, and I think it's important to just look back so that we can look forward into 2024, if you like. Now, don't need me to tell you it's been a tough year. We've had the Russia-Ukraine war, conflict in the Middle East, inflation, which, as I make this video, is starting to come back under control, but was back up in double figures for a chunk of the year. Much higher interest rates than traditionally we've been used to over the last, say, 20 years, and quite a bit of volatility, whether you're looking at shares or bonds or even other parts of the market. So what are my takeaways? And I'll summarize them now, and then we'll go back through them in a little bit more detail. Number 1, the stock market is never the economy. Number 2, geopolitics matter. But number 3, interest rate policy seems to matter more. Number 4, bonds and shares can sometimes move together, but don't panic about that. And number 5, don't panic about that or anything else. So, the stock market is not the economy. Now, I've made this point before, but it's really important. People sort of say, well, how come with all of this stuff going on since 2019, the stock markets in the US and the UK have kind of managed with a few ripples to power on upwards or certainly drift up. What's going on there, Tim? In other words, on the ground, things look pretty grim, but up at stock market level, things don't look quite as bad. The simple answer is that stock markets look forward. The past is largely irrelevant. What stock markets are trying to do is look ahead. What are they looking ahead to? A point, let's hope, where some of these conflicts are resolved or some kind of compromise is reached, but more importantly, a point where inflation is well back under control, interest rates might be able to start to come down. Now, this may take months from the point you're watching this video, but nonetheless, they're looking ahead. A point where we're perhaps through any recession in the UK, Europe, and or anywhere else in the world. So that's important, all right? Shares very rarely reflect the data, economic data you're seeing in the press that day, because the people who price shares for a living are trying to price the future. Number 2, geopolitics matter. We've had 2 decades of calm, now we don't. All right, and you don't need me to summarize it, but the US is facing 3 difficult fronts defensively, the US being, the biggest Western democracy in the world, if you like. Those fronts being Russia, the Middle East, and potentially even China, should something happen around Taiwan, for example. On top of that, the US itself has got elections coming up, so have we. So geopolitics has gone from being quite calm and predictable to being the exact opposite, all right? And there's no doubt about it, that's not about to change. That, I think, is a guarantee, unfortunately, for 2024 and possibly beyond. So it's a case of adapting to the new normal, because stock markets don't seem to have been unduly fazed by this new geopolitical risk. What they do watch carefully is interest rates. So my third takeaway is that interest rates still matter. If you look at what markets do, most of it can be correlated to what central banks decide to do about interest rates, and that in turn is pegged on inflation data. So you need to be watching the inflation data, and then what professionals try and do is anticipate when, for example, the Bank of England might cut interest rates. That is good news for stocks. But don't forget what I said, stocks are looking ahead. They're not waiting around for that decision, they're trying to anticipate it. All right, so rates matter, inflation matters, and it will continue to do so. Now, the reason is very simple. It is the ripple effect that interest rate decision potentially has right across the economy. So if inflation comes down and interest rates follow, you get cheaper government borrowing, cheaper corporate borrowing, cheaper personal borrowing in the form of mortgages and so on, and that tends to stimulate risk appetite amongst investors, amongst consumers. People buy more stuff. Next point. We've seen this year that bonds and shares can move together. Now, for anyone thinking, what's the problem there? Well, traditionally people buy in a portfolio bonds and shares because they don't move together, all right? They try and put a portfolio together that's diversified. So if the stock market takes a bit of a move down, the bond market might compensate. But this year, we've actually seen the fairly unusual situation historically where shares and bonds have sometimes gone down or even up, but more like down together. Now, so what was happening there? I mean, do we assume bonds are no longer a great diversifier? No, they are a great diversifier, all right? They carry a fixed income in a lot of cases, which shares don't. There's a predictable total return from them if you buy and hold them to redemption, which shares don't have either. And they can be really low risk if you buy them from governments like the UK or the US in the form of gilts, all right? But what we've seen this year is the destabilizing effect on the bond market in particular of multiple conflicts, the parlous state, as some see it, of borrowing in the US and the UK markets as far as the governments are concerned, the debt ceiling as it's called, and the prospect of breaching it, hitting it and breaching it in the US has caused markets to wobble. And of course, the big unknown that is China and what its intentions are globally, and in particular around Taiwan, a very important source of global chips, for example. So, yes, bonds and shares can move together. Bond prices can drop with share prices, but it's not typical, and I wouldn't necessarily assume that's some kind of new normal. Next lesson, panicking doesn't pay, and this is my final one. I could have brought out more, but this is an important one. So there's been lots of media gloom this year. It's been quite depressing, picking the newspaper up, turning on the TV. There have been a lot of shocks, and not just they're bad enough, Russia, Ukraine, Middle East, and so on, but you've had the collapse of FTX, Sam Bankman-Fried, a massive firm in the crypto space, somebody in prison who was all over the TV screens seeming like only a few months ago. So lots of reasons why people might push the sell button. Think, oh, I've had enough, too risky, too volatile, I'm going to just sit on some cash for a while, I'll come back to the markets later. But that's never a good plan. Basically, if you bail out of the markets, there are plenty of studies that suggest the difficulty is that markets tend to bounce sharply after they drop sharply. It's just human nature. People panic and then they get their confidence back. All right. So if you miss out on that sharp correction upwards, bailing out the market can be expensive. It's stressful. All right. I mean, you've got to make two decisions, as I said before, when to sell, when to buy back. It can be expensive. You've got transaction costs involved there. And you've got to be really careful that you don't then sit out of the market worrying about when to go back in again. It's sort of loss aversion risk. So you think, well, I made a bit of money because I sold at a good point. I'm now sitting nervously on the sidelines, and I'm actually now, the longer I stay on the sidelines, the less likely I am to go back in. In other words, it can breed bad habits, sitting on the supposedly safe asset of cash, but actually when inflation's around, as I've demonstrated in other videos, not so safe. Okay, so what I've done is covered quite a few different topics there. I've tried to wrap up 5 key messages from 2023. If you'd like a bit more detail on any of the things I mentioned as we went through, whether that's bonds or the collapse of FTX or why you shouldn't panic sell, then killick.com/learn or Killick Finance videos on YouTube. 2 good places to go. If you want some guidelines on the best way to invest in equities, this guide is editor@killick.com. If you can't see the title, it's How to Invest in Equities, I suppose not surprisingly. And then Confidant is our quarterly magazine, and that contains some practical context for some of these messages, and that would be, again, editor@killick.com.